Welcome to an exclusive webinar powered by Tata AIA Life Insurance. I'm your host, Pallavi. If you are looking for complete financial planning and if you have realized how essential is comprehensive planning, especially after a challenging year like 2020, then this is the place to be. In this special session, we are going to discuss why you need a comprehensive plan and how you can take care of all your health, wealth, and investment needs. I'm happy to be joined by Mr. Samit Upadhyay, Chief Financial Officer and Head of Products, Tata AIA Life Insurance. I welcome you, Samit, on this special webinar.
Thank you, Pallavi. Thank you. Glad to be here.
So, Samit, talking about this entire year that has gone by, everybody knows how the financial well-being was impacted. Uh, According to you, what are the things that one needs to take care of and what can be done? How can we make good use of this year in time to plan for the financial year, which is going to end in March? So we still have 3 months in hand.
Sure. So, unfortunately, this year, the year that went by was one in sort of 100, one in 200 type of an event. And it was an extreme event, which sort of made us, it sort of was full of doom and gloom. And typically, in such a scenario, people think about insurance the most. And it is hard to not think about the adequacy of cover or the need for adequate protection. So here is what I would sort of say, and how as per how I went ahead planning this for myself. Um, so so you need to in some sense, let's say in a mathematical sense, you need to map your responsibility and your resources. Let's say and the responsibility should not only include the responsibility towards family, but the responsibility you owe to yourself. Post retirement is a responsibility that you owe to yourself. So responsibility to your family, responsibility to yourself on one hand, and the resources on the other. So suppose ideally, in an ideal case, suppose you have enough resources to take care of all the responsibilities as well as yourself. Do you need insurance? No, you don't need insurance, because insurance is not a tool to make money. It is the primary aim for insurance is protection, and to basically fill the deficit between the resource and the requirement. So if you do this carefully, and typically for any person, the requirement for cover will be in sort of a bell shape. Basically, it goes up in the beginning as basically you progress, as you have family, as you have children, their needs, and it basically peaks at a point, and then thereafter you have wealth, you have funds, and you have some contingency buffer for yourself, and then it starts to come down, and basically such that your retirement is taken care of. So you should think about insurance as a cover, and depending on which stage you are in life, and you could imagine that part of bell to be the right cover that you need.
Right. In fact, you mentioned about different stages of life. So it won't be wrong to say that one goes under, changes and transitions throughout one's life. So there could be reasons like a new member in the family. There could be reasons like somebody, getting a hike, or maybe, a demotion, or anything of this sort. So there could be different life stages. So tell us, I mean, how can one make sure that his changes in his lifestyle are aligned with the changes in his investment planning as well?
Well, there are multiple ways of doing this, and one is free to sort of adopt whichever is the most convenient platform or accessible platform. At Tata AIA, we've created this platform, or a chassis of sorts, which basically acts as a layer, or a platform where you can add components of cover as and when you need in your lifestyle, depending on your lifestyle. So you could start with a plain vanilla mortality cover base layer. So let's call that the base protection layer. Then you could basically add minor elements of, let's say, critical illness cover. Now, critical illness, typically most of us in the organized sector have some sort of indemnity, have some basic reimbursement type of cover, assuming that we have uh, that. Then what is required at the next level is a critical illness cover, because mind you, if some unforeseen event would happen to you, just a insurance cover that pays on death is not sufficient, because you
Right.
need something to help you survive. I mean, to basically replace your income while you are temporarily incapacitated for some or the other purpose. Now, so critical illness covers act like that those shock absorbers, which basically absorb these shocks that happen during our lifetime, such that our overall planning, our the overall wealth planning that we have done for ourselves, including the retirement planning, does not get impacted. Basically, that aspect of our life is unaffected or insulated by this unfortunate small event that happens. So you build on the protection layer, you build a critical illness. You could add a layer of let's say hospital cash, basically, which is uh, uh, reimbursement or a fixed cash outlay upon hospitalization. And then you need to ensure that these covers don't basically these covers cover the entire tenure of a good amount of your expected lifetime. And let's say typically 30-40 years you take this cover, and at the end of it, you don't want to be in a position where you sort of invested money, and basically you've kept your money for sufficiently long duration, and have sort of have suboptimal returns. So you could get some equity exposure, especially for the long duration that your money is invested in, because you could participate in the equity growth story that is pretty evident in India. So with this platform, not only are you taking care of your protection needs, but also critical illness, some health needs, as well as the wealth layer. So the surplus after having provided for all your basic necessities is the wealth that is left after.
So, Samit, as we're discussing about the various aspects of insurance, tell us how and why is insurance the first step to financial well-being?
Yeah. So, Pallavi, if you saw what the recent pandemic has made very evident, that a small contingency can basically turn the entire events of life, the whole world, topsy turvy. And so, I mean, what the key learning from that is that insurance are basically the shock absorbers in our lives, which basically make the rest of the journey smooth. So hence, insurance being as a primary layer to any financial planning will make sure that the other layers of the financial planning that you've made for yourself are sort of are intact, and they are not disturbed in case there is an unforeseen contingency. Hence, in that sense, protection or insurance is the first layer, and savings is sort of a secondary need for one's superior financial planning.
Right. In fact, Samit, what we've noticed is that typically, policyholders, they don't get into the details. They may buy one policy just for saving the taxes. They may buy one policy for their health requirements and one policy maybe for, their retirement planning. But is there a comprehensive plan wherein all these aspects are taken care of? And also tell us, what are the benefits? Like, as we rightly mentioned about the different aspects which need attention, but typically in a scenario where people are not aware of, tell us more about a comprehensive plan.
Yeah, so you're right. Historically, what we've seen is that people, some even the best of us have bought have made these sporadic purchases, and there is one insurance policy with this company here for a small sum assured, and then the other policy there. So managing all of it, remembering to pay premiums for all of it, so that it is in force, so that it is sort of available when you need, has historically been slightly challenging. So here, that is the key reason why we have this platform, the product, that a comprehensive solution, which basically you build on the base layer, component by component, so that it is all together. It remains in front of you. It is visible. It is very clear. It is effectively very segregated. So that you don't disturb one exigency. In an exigency, you don't disturb a cover or the other, etc. So that kind of a segmented approach to your needs is what is recommended.
Sure. In fact, how does one know what is missing in his own insurance coverage, and what should be the ideal approach to financial planning?
Yeah. So what is missing is, traditionally, the most of us have had low covers. So the adequacy of covers, and there could be multiple ways to assess the adequacy. There is a very popular tool called a human life value calculator, which is basically in some sense it sort of pans out the number of productive years that as a person would have remaining or outstanding, and depending on that, it sort of that gives us a multiple, and that multiple is applied to your income to basically come at the total coverage needs. So that is a good proxy for the adequacy of coverage, as to depending on your productive life, if do you have adequate coverage. Uh, then you need to think about what coverage do you have against. It's not just uh, enough to just think about, if you have a life protection, let's say a protection plan that covers life as an event. Most of the time that is not enough. You need critical illness, you may need accident cover, you may need cover on disability, you may need certain plans that cover hospitalization. So one needs to do a careful evaluation of the needs, as well as the basically the risks, as well as the amounts for each of those risks, to gauge the adequacy.
Absolutely. So tell us, Samit, why is there a need to recalibrate the adequacy of insurance coverage, maybe with different stages in life?
Yeah. As I mentioned earlier, one needs to look at the responsibilities. And when I say responsibilities, I mean one needs to carefully assess each responsibility in sort of a slightly granular manner. And like for instance, your responsibility towards your spouse, your responsibility towards your parents, your responsibility to your children, and after all of this, your responsibility to yourself, for to basically to ensure that you have independent retirement, and basically you're not sort of dependent, or relatively lesser dependent. So you need to basically chart out each of your responsibility. Then, on the other hand, you need to track your resources as to how much resources do you have to meet all of these responsibilities. If and then carefully allocate the resources that you have, basis each responsibility, depending on which is more dire, which is more near term. So, for instance, once you've started allocating resources for protection, and the resources allocated to protection is sort of sufficient, then you can start on your journey to plan retirement.
Sure, sure. In fact, Samit, what we've seen is that in the current linked, insurance plans which are available there in the market, they don't offer adequate insurance. That is, the amount of insurance coverage is too low. So, could you tell us more about this new product of Tata AIA, and how does it differentiate from the other products which are already available?
Sure. So this new product is unique in the sense that historically uh, unit link plans came with a very low sum assured multiple. So for
Right.
example, if you had 1 lakh of disposable income for the purpose of insurance, then you would get a cover of 10 lakh. Now that is a 1:10 ratio. I mean, typically this kind of ratio is I mean, that's like the minimum cover that the insurance products carry, and most of these historical link plan have been sold as investment vehicles instead of protection
Right.
vehicle. And if you see the primary purpose of insurance being protection, this new plan by Tata AIA is effectively changes that. And so instead of a minimum sum assured multiple of 10x, it can offer sum assured multiples of up to 200x. So
Okay.
so it's more of a protection plan, and savings is secondary.
Okay.
Because if you think of your need, primary need is protection. That's why you look at insurance. Otherwise, I mean, there are multiple companies in the financial services sector that cater to your savings need, but insurance companies are known to take care of their protection needs, and that is the
Right.
primary need. So this plan is a protection plan that gives you an equity linked upside
Okay.
in case you in the happy event that you don't claim in your policy, so that even if you don't claim by the end of the term, instead of just getting your premiums back, I mean, there are some variants that at the end of the term give you your premium back. Instead of just getting premiums back, we give you an upside depending on your fund choice at the end of the tenure. So such a plan that caters to both a high level of sum assured as well as equity linked. So combination of the best features of unit link as well as best features of protection is sort of bundled in this plan.
Great. So before we make us understand more features of the Param Rakshak and Param Rakshak Plus plan, we want you to tell us about the importance one should have, when it comes to their health, wealth, and their life covers when they are doing a comprehensive financial planning for them and setting up goals. So how important are all these three aspects, and what is the measure? I mean, how should that be measured? Like you were mentioning about the existing plans and the earlier kind of ULIPs that they were there in the market. So as of today, looking at the current inflation rate and medical inflation and other such factors, how does one evaluate what percentage or what should be the sum assured typically in these three scenarios?
So as I said, so if you imagine your age on a number line, let's say starting from 20 to let's say 60, right? So the amount of cover that you need will be like a bell shape. So it will basically it will keep going up. Maybe it'll peak at the time of 30, 40, and then start coming down. So depending on your life stage and which age you are, so you need to effectively see that, okay, had you survived for the tenure, let's say one is a 30-year individual, and had he survived till 60 years, will there be a need for protection? I mean, so what are the responsibilities that he needs to be fulfilled in the first 30 years? Let's say there is a need for kids' education, there is a need for a certain sort of sustenance of lifestyle, there is a need for a certain amount of fund in case there is some unfortunate event. So depending on one's need, and let's say you have X number of children, and so let's say you have two children and you need to provide for education for both, or you need to provide for some level of sustenance for both. So it is basically dependent on how you uh, would have provided for your dependents, and insurance is meant to substitute for that portion of your wealth creation. So depending on one's responsibilities, one can sort of design this cover.
Sure, sure. And in fact, we're just not talking about the new, policyholders. We're not just talking about people who, planning to buy insurance, but already people who have, X number of policies. How do they evaluate that this is missing in their policy? Like, what are the key things that one can see to, make a comparison as to whether
Yeah.
or not he wants to buy a new plan or not?
Yeah. So the first element is about the adequacy. So how much of cover do you have? So I remember. I mean, I'm sure most of our parents bought some or the other insurance policies for us, and you can go and
Mm-hmm.
look at the sum assured, and you'll be amazed at how low the sum assureds were,
Mm-hmm.
and how historically we've not thought about this adequately. So, and there is a Swiss Re report which basically shows the amount of protection gap in India,
Mm-hmm.
and in India. The protection gap is one of the highest, and it's almost like 80%. So what 80% means is that suppose you need a protection of 100 rupees, what you
Mm-hmm.
have today is just 20. So it
Right.
is almost every one of
Mm.
us needs to evaluate the adequacy of cover. That
Okay.
is first.
Mm-hmm.
Second is the duration for which you are covered. Some of us have taken plans historically or are covered in durations which are like 10 years, 5 years, 20 years, up to age 60, up to age. So you need to evaluate what is the duration of cover that you need. Some of us plan for legacy. So maybe we need a whole of life plan so that, some of us could think that I have two children, and I all my resources or the wealth that I create will go to
Mm-hmm.
one, and the insurance cover will basically help me pass on some legacy to the other. So
Right.
so in this way, there are multiple ways to think about how you want to plan the coverage. So adequacy, the tenure for which
Okay.
you want the cover. So
Mm-hmm.
those are the two key aspects, whether uh, one should sort of evaluate if this is taken care. Then the third element is the risks that
Mm-hmm.
one is covered for. So in your plain mortality cover, do you have any coverage for, let's say, cancer? Now cancer and cardiac events, just these two critical illness combined is almost is close to 60% of the total incidence of critical illness.
Mm.
So are you do you have any cover for that? Because just saying that, oh, I have insurance, and without evaluating for which risks these covers are for, can basically leave you for a negative surprise at the unfortunate event, if that were to arise. So the next step is to evaluate the risks that you're covered for,
Mm-hmm.
and yeah, and then, after all these coverages, because typically these are long tenure plans, what do you have at the end? Suppose you find yourself in a happy place where you have survived the tenure of 30, 40 years. You I mean, what is it that you have left with you for 30, 40 years? What is the expected wealth that you will create through this vehicle
Mm-hmm.
by the end of that tenure? So one can evaluate in this manner as to, and if the answer for any of these things is, let's say, a yes or a very, very positive yes, then this new product that we have, the package that we have created,
Right.
will help you address this need.
Right. In fact, you used the absolutely right word for it. I was just about to say that this comes as a complete package
Right.
wherein the life insurance cover, the critical illness cover, and the investment aspect, that is the return, is taken care of. So, could you tell us about the eligibility? As in, according to you, are there any specific type of individuals for whom it is more suited, or you think that this plan is something that can be opted by any of us?
So as far as the eligibility of the product is concerned, so anybody who's between the age of 18 to 60 years, and is basically is planning for a coverage of 30 or 40 years, uh, and has resources to discharge this obligation either through regular pay, as in every year of the term, or by limited pay. So basically, for a 40-year coverage, one could pay premiums in 5, 10, or 12 years. So basically, those are the contours of the eligibility, and depending on your resources, you could think about buying this plan.
Sure. So with that note, let's start with some questions that we've received from our viewers. The first question is typically on the fund value of the plan, the different benefits that it offers. So one of the viewer wants to know, how is the fund value calculated on maturity, and what is the kind of return one can expect?
Yeah. So while past performance is not a strong indicator of future, or not does not guarantee future performance, but I must share that the funds at Tata AIA are rated by an independent rating agency called Morningstar.
Okay.
And as of the most recent rating, 99% of Tata AIA's funds are either 4 or 5-star rated, which is, I mean, almost 100% of the funds are one of the best. I mean, there are, and those are one of the best fund performance that an independent agency called reputed international independent agency called Morningstar sort of can vouch for. So that's why this is another unique aspect of this plan, which basically marries one of the industry best fund performance with a protection cover, and basically you get the best of both worlds.
Both worlds. Great, great. So the next question that we are taking up is by our viewer, and it's one of the common questions which typically we find what viewers want to know. He says, I took a policy a few years ago when I started working. So am I set for life?
Yeah. So again, in the same measure, has any responsibility changed? Is a lifestyle? Is there a change in his lifestyle? So if the answer to any of this is yes, then yes, he needs cover. Then he needs to evaluate resources, as in he could be planning for a particular lifestyle where his income was low, but now with a higher income, does he plan for a better lifestyle? Or does he want to sort of yeah, I mean, so those two aspects, responsibility and resources, if any of these change, then basically there is a need to recalibrate the need for coverage again.
Um, let's move on to the next question. The question is that is there a current plan, existing plan that takes care of all our health needs, wealth, and investment needs? Could you suggest which one to buy?
Yes. So PR Plus, Param Rakshak Plus is the most comprehensive plan that we have at the moment. That addresses your protection needs, critical illnesses, as well as some hospital cash type of benefit. So it is one of the most protection comprehensive cover that we have at the moment.
Okay. The next question is more of a comparative kind of a view. The viewer wants to know, how do we differentiate, as in when it comes to benefits, between a term insurance plan and an endowment plan, and which one is better? I mean, which one should he go for?
See, the term insurance plan are plans that cover you for the term of the policy,
Right.
and at the end of the term, you do not get anything. I mean, if you survive, then you do not get anything, because the nature of the term plan is just to offer that coverage during that tenure. In an endowment plan, typically the covers are very small. So let's say the covers would be 10 times your premium. That is the default covers that most endowment plans have. And at the end of the tenure, you get an accumulation of your premiums back. So endowment plan is more like a savings vehicle. which basically, depending on which plan you buy, either guarantees or gives you a guarantee plus an upside. So that is an endowment plan, and term is a protection plan.
Sure. So I hope that answers the question, difference between the two plans and how you should choose them. So another question, this talks about the maximum tenure. So basically the viewer wants to know that in both these two products, what is the maximum tenure and how long is the premium paying term?
Yeah. So the maximum tenure that we have is about 40 years. Which is pretty much, if you see it, it covers the entire gamut of one's life tenure. Uh, and the premium payment term options that we have are 5 pay. You could take a plan that offers you 5 pay, 10 pay, 12 pay.
So it's flexible.
Yeah, that you have
Okay,
that.
okay, great. So you can choose the term according to your own needs and requirements, and then accordingly go for it. So let's take a couple of more questions. Another question talks about, if you could explain the critical plus benefit of these two products. What all the illnesses are covered, and what are there any conditions as to the gap or how many years after it's covered or something.
So the critical illness plan that we have covers 40 critical illnesses. These are pretty much these offer a wide spectrum of critical illnesses, as you can see. So it's pretty comprehensive.
Okay. So we'll take up one last question before we close the session. And we've talked about the different benefits, different layers of the offers that the product offers. Is there what are the things that one needs to have in the mind? Like, what is the kind of checklist one should go for while buying an insurance plan?
So the things, the minimum things that one should sort of consider while buying an insurance plan is basically uh, have on a piece of paper lay out all the responsibilities, right? And responsibility, so that you basically isolate, and instead of making up one pot of money and just leaving it for chance, one should go slightly more granular about the responsibility.
Okay.
And then the next step is to think about the tenure for which you would be requiring this, the tenure for which in which you will sort of have discharged this responsibility. And the third is how are you capacitized to pay for this? So would you want to pay for these over a span of 40 years? You would want a shorter span, let's say 5 years to this thing. So that's the third.
Okay.
The fourth thing that one should think about is the risk coverages that one needs. So let's say you have the plain mortality, then you have like an accident coverage, then you have like a disability, you have critical illness, you have hospitalization. So these are the risk coverages that you basically think about. And yeah, I mean, that's those are pretty much the things that you need to.
Sure. I hope that answers the question of the viewer. So before we let you go, Samit, one last thing that we want you to talk about to sum up the whole theme and the whole session is that this kind of a plan, the aim or the purpose of this plan is to give all the the offers, the layers that we were talking about during the session. You think that this is also sort of a game changer? You think? Because importantly, if you look at insurance, maybe 10 or 20 years ago, this seems to be the most, the one sector which has gone through a lot of changes, a lot of regulatory changes. And when it comes to products also, there have been a lot of experiences and a lot of experiments, I would rather say. So you think insurance as an instrument remains a very less understood or maybe misunderstood sort of a product. So overall, how does one look at insurance? Like, what is your idea?
Yeah, I mean, so you're right. insurance as an industry has undergone an evolution of sorts, and here at various stages, the regulator has also nudged the industry in sort of the right direction, uh, and to basically in the very early days, most of the plans were very savings focused. So they used to offer protection, a small amount of protection, some protection in terms of maturity benefit. So basically, you are, I mean, life insurance is the only industry, if you see, that offers guarantees. So while there are other industries who offer smaller term guarantees, so like an FD or a RD are relatively smaller term. But if you look at the entire tenure of 30, 40 years, life insurance industry is 1 million. So it offered protection through savings in the early part of the privatization, and then since then the core need of insurance has come in the forefront, and almost all the key players are offering or are focusing on protection, which is the primary need. So other than protection, then there is the retirement planning, so the pension need or the annuity. Uh, so pretty much over a period of time, insurance as a sector has refined itself and made the offering more sharper and more focused, instead of competing in spaces where there are, which is sort of where there are alternate instruments available. So
Sure.
yeah.
So indeed, that was a great session. We learned a lot about insurance and why it is important to, think from a comprehensive perspective. That brings us to the end of the session. Thanks a lot, Samit, for your precious time.
Thank you.
And all the viewers, stay tuned to ET for more updates. Thank you.